The central issue that we discuss is, we ask this question: how does having contract workers impact a firm's ability to cope up with negative demand shocks? By negative demand shocks, I mean something, let's say a situation where interest rates go up, or there is a drought, or any other reason where firm sees lower demand for its products. So I call upon my co-author Raja to explain this with a simple example.
Hi, I'm Raja. I'm third year PhD student at ISB. We present a simple example in the paper to illustrate our finding. Let us consider automobile industry in which firms compete to manufacture cars. Let's say there are two firms, Firm A and Firm B. Firm A employs only regular workers and Firm B employs only contract workers. At equilibrium, each firm manufactures 10 cars by employing 100 workers. We also assume that the wages of regular workers are rigid. Let us now consider a negative demand shock in which the price of each car comes down by 20%. If the wages of workers are rigid, it is optimal for each firm to manufacture 8 cars by employing 64 workers. Since Firm A employs only regular workers, Firm A's production comes down from 10 cars to 8 cars after the negative demand shock. Let us now consider two scenarios. In scenario 1, wages of contract workers are rigid, and in second scenario, the wages of contract workers are flexible. First scenario, if the wages of contract workers are rigid, Firm B also finds it optimal to manufacture 8 cars. Thus, there is no difference in production between two firms after the negative demand shock. However, Firm B has an advantage. Since it employs only contract workers, it can let go of 36 workers and mitigate the hit on profitability. Second scenario, suppose that the wages of contract workers also adjust downward by 20% after the negative demand shock. If the wages of contract workers are flexible, Firm B now finds it optimal to manufacture 10 cars by employing 100 workers. In this scenario, Firm A manufactures 8 cars and Firm B manufactures 10 cars. Thus, when contract worker wages are flexible, there is lower impact on output after the negative demand shock.
I hope the point is clear after this example. When you have contract workers, you can fire them easily, and therefore your profitability will not be impacted as much, because imagine you have regular workers, you have to keep them paying wages even when you're not producing. So production would go down, but profits also will go down, but as when you have contract workers, it will go down less. This is what literature has shown so far. What we find is contract workers' wages are more flexible. That means when you face a negative demand shock, contract workers' wages reduce. Now, what it does, it shields output from these shocks. Output does not fall as much as compared to a situation where you have regular workers whose wages are sticky. So when contract workers' wages adjust to shock, so you can have a situation where you have a demand shock, the shock is absorbed by the wages and not by output. So production continues at the level as before, not exactly as much, but it won't go down as much as it is in case there were only permanent workers. So contract workers work as some kind of a shock absorbers when there is a negative demand shock. This is the finding of the paper. Now, what's the point of knowing all this? What's the benefit for the policymakers, and what's the benefit for those in business, and obviously for academicians? So let me start with policymakers. Our paper helps policymakers assess when they especially those from the central bank, when they change interest rates, what are the parts of the economy where the impact is likely to be higher on growth? Areas where firms employ more contract workers will show lower impact in terms of contraction. If RBI increase or any central bank increases interest rates, parts of the economy where employment is mostly contract type, impact on output growth is going to be lower, where an impact on prices is going to be higher. That's the first thing for the policymakers. Now, for businesses also, let's say there are businesses are thinking about hiring contract and permanent workers, and if everything else remains the same, this is important. Obviously, efficiency levels may be different. If everything else remains the same, then we highlight one important advantage of having contract workers. The advantage is the flexibility of wages will prevent output contraction when shocks are hit. And remember, this is not just monetary policy shocks. It can be in any shock, any kind of demand shock. And finally, for academicians, the issue is about what determines wage rigidity. It's a very important question in macroeconomics. People are figuring out generally price rigidity and wage rigidity. We don't understand what exactly determines wage rigidity, and we are showing form of employment contributes to this wage rigidity. It is the contract form of employment can reduce wage rigidity, increase wage flexibility. And one important thing, papers have established that wage rigidity is asymmetric. That means it's difficult to reduce wages of permanent workers, nominally, even when price growth is low, or even when there is, like in China right now, when there is deflation. Our research says that having contract workers offsets this, downward wage rigidity of labor. So these are three major takeaways for three important constituents.